Let's talk about OPEC and the allies. They got together, they met, and they agreed to boost production by another 400,000 barrels. Being taken, it seems, in the market as a sign that energy demand is holding up, and it's a bit of an optimistic take on the demand for crude this year. Let's talk about what it all means with Josh Young. He's a CIO of Bison Interests. Great to have you with us to start off the year here, Josh. Let's talk about what OPEC did today. It does seem to be taken as sort of a sign of faith that demand will continue to hold firm despite what we're going through right now with the pandemic.
Yeah, that's right. I mean, it's been interesting because this is definitely worth watching and paying close attention to on a monthly basis because of the disruption that's happened in the past when OPEC hasn't been able to reach a positive agreement. And so I think a little bit of what we're seeing every month as OPEC continues and OPEC Plus continues this agreement is just a little more faith and a little less risk priced into the market that some sort of disagreement ends up blowing up the market. So I think actually that was the big thing. OPEC's assessment of Omicron or whatever is probably not a big mover for the market. I think people are able to tell themselves. And I think we're seeing that cases are starting to peak and starting to roll over in many places. And I think, like you were reporting earlier, in the UK and other places, they're choosing not to do further lockdowns. So I think it's less that and more just, OPEC is staying the course. Russia and other OPEC Plus members are participating. And, things look really good from here if they just continue to participate.
Always good when a cartel can get along. Otherwise, what's the point of having a cartel? Good point on that front. I know in the past, though, Josh, you've been doubtful that some of the members of the OPEC Plus alliance can actually make good on some of these targets of boosting production. Where do you sit on that now?
Yeah, I mean, not only do I think that, now a number of investment banks have been saying it, some investment strategists have been saying it, and actually some former and current senior execs at Saudi Aramco, and I think some of the big Russian oil companies have been saying it too. So I think it's like, shifting from kind of, I've been saying that 2021 and now 2022 have been the year, or now years, where conspiracy theories are becoming headlines. And so I think there was a lot of doubt and uncertainty and a lot of pushback when we came out saying that OPEC Plus might not have as much spare capacity, and now it's becoming increasingly a headline. So specifically, what's happening is that I think everyone in OPEC Plus is realizing that they benefit if they just keep things as is, continue on the agreed upon path, and just ignore that multiple countries are missing their quota amounts and treating them as maximums instead of as guides. Seems to be working for everyone. So I don't think they see any reason to change. And then they just announced a new head of OPEC, Secretary General, I think it's called, and that head is from Kuwait, which is a country that's kind of been bumping up on their maximum capacity already. And I think that's a good indicator that they're just going to keep participating and continue this agreement that seems to be working better than I think they ever expected.
Now, when we take a look back at 2021, obviously crude had a great run, but things got a little shaky and volatile in November, a pretty sharp pullback. And of course, that would have been an opportunity if people got in, because of course, then we start to find our feet again. What's the trade going to be like this year? Is it going to be a little calmer? Or do you think we still got some volatile times ahead?
Yeah, I mean, I think it's a great question. And, I made sure that you guys had the CBOE volatility index. And if you look back over the last 6 months or year, there have definitely been a few times where that oil volatility index spiked. And generally, my view has been that we're now in kind of a new paradigm for oil versus kind of what we saw before the pandemic. And it looks like we're in an oil bull market. And the argument is that in bull markets, you buy dips. You don't really try to time the market too much. And so, we've talked about this in July and August and early September, where things looked pretty tough for oil, and things looked pretty tough in November, early December. And I think it's just being able to look through kind of the short-term noise. There are many market timers, many supposed experts and strategists that have suggested different indicators to buy or sell or whatever. And I think you just look at the fundamentals, you look at kind of the trajectory, which is inventories continuing to fall, industry capital expenditures continuing to be very muted versus historical, and things look great. And I think it's a mistake to allow fear or uncertainty or kind of weird technical signals to dictate what can be really successful multi-year investments.
Josh, I only got about 2 minutes left with you, unfortunately, but we've got two names on deck for you to chat with us about. Journey Energy, what are you seeing here?
Sure. Yeah. So I wanted to make sure you guys had a chart that Peters & Co., a great Canadian local energy investment bank, put out. And they put this out a little while ago, but it's still helpful for understanding kind of dispersion of free cash flow among producers. And so we've done really well, and we've done well in a market that's done well, but much better in the market. And we've been able to do that by picking the ones that have more favorable characteristics for positive return. And one of the measures for that is free cash flow, along with inventory, along with improving situations and growth and so on. And so I think Journey screens very favorably on that front. And they're also just so underfollowed that no one's giving them credit for their ramp up in production that they're going to achieve this year, likely, as well as their massively accretive acquisition that they did in the middle of last year. So I think more to come for them. And then similar for Baytex, it's interesting because Baytex kind of screens down the middle for free cash flow, but it's down the middle if you include companies that have much lower returns on invested capital and kind of much kind of crazier histories and backgrounds and asset bases and so on. I think Baytex is really similar to some of the US top tier return names like an EOG or a Pioneer. And those are companies that had historical hair and uncertainty and lower valuations and have built over many quarters and many years high valuations. So I think Baytex, especially with their Clearwater play, which is a top play in North America and in the world, I think they're in the process of going from kind of a average-ish or low-ish valuation company to one that could be one of the highest valuation in the peer set because of the high returns. And because of their high free cash flow and because of their torque, they might actually outperform even more than they would have otherwise in that transition from kind of an average-ish valuation to probably a rich valuation over time.